All right, welcome back everyone to another explainer. Today we're cutting right through the noise. We're going to break down a highly clinical, no-nonsense intraday trading strategy that relies on just three simple indicators: the 9 EMA, the 20 EMA, and the VWAP. So if you've been searching for a real, repeatable edge in the market that doesn't involve just crossing your fingers and guessing, well, you are in exactly the right place.
Look, we've all been there, right? Staring at a screen that literally looks like a neon spaghetti bowl of lines, bands, and oscillators. You have to ask yourself, are messy charts and overwhelmingly complex indicators making you miss the actual price action? Chasing these chaotic, indicator-heavy setups is such a common trap. Successful trading really isn't about having the most indicators crammed onto your screen. It's about having a clean, strict, rule-based system where every single line you look at has a very specific job.
Okay, let's dive into this. Here is our syllabus for today's explainer. 1. The myth of magic indicators. 2. Meet your three witnesses. 3. Stacking the golden setup. 4. Pullbacks and entry rules. And 5. Strict risk management.
Starting off with Section 1, the myth of magic indicators.
We absolutely have to start here to shatter the illusion that any single indicator, whether that's an EMA, RSI, or VWAP, is somehow a magic, guaranteed buy or sell button. Professional traders operate on what's known as the lawyer framework. As you can see, VWAP and EMAs are evidence, not the verdict. Listen, every single trade you look at essentially starts as a 50-50 coin flip. Your job, much like a lawyer in a courtroom, is to build a compelling case using corroborating evidence to push that coin flip into a high-probability setup before you risk a single dime. No case, no trade. It's that simple.
Let's move to Section 2 and see how this builds. Meet your three witnesses.
Our first and, frankly, probably most important witness is VWAP, the volume-weighted average price. VWAP isn't just some arbitrary math formula, okay? It literally represents the institutional bias of the entire market. Big money, we're talking hedge funds and institutional trading desks, they're legally and professionally graded against the VWAP for the best execution of their massive orders. Because of that grading, their algorithms are out there actively buying dips and selling rallies right around this exact line. So it basically acts as this self-reinforcing zone of support and resistance.
Next up is the 9 EMA. Think of this line as a literal shadow to the price. Because it weights recent price data much more heavily, it's incredibly responsive. It shows us exactly where the immediate short-term momentum is heading. It just perfectly balances speed to help you catch those really quick intraday scalps while doing a great job of filtering out the extreme erratic noise you'd normally get from a faster, say, 5-period average.
And finally, our third witness is the 20 EMA. This guy acts as our midterm smoother. While the 9 EMA is fast, it can sometimes be just a little bit too eager. So pairing it up with this 20 EMA is absolutely vital for noise reduction. The 20 EMA acts as this trend filter to confirm if a momentum shift is actually real or if it's just a temporary hiccup in the market. It keeps you out of the really dangerous sideways chop.
All right, moving into Section 3, stacking the golden setup. Visually, this whole framework dramatically simplifies your trading bias. We are looking for absolute, unquestionable alignment. So, for a bullish stack, meaning a long entry, the price must be above VWAP and the 9 EMA has to be above the 20 EMA. Conversely, for a bearish stack or a short entry, price must be below VWAP with the 9 EMA below the 20 EMA. If your chart does not perfectly match one of these two specific stacks, you stand down. You simply do not have a case.
Section 4. Pullbacks and entry rules. Now, the crucial point is knowing when to pull the trigger. And I want to introduce you to a fantastic concept called the bone zone. This is that critical pocket of space sitting right there between the 9 EMA and the 20 EMA. Look, a massive amateur mistake is experiencing FOMO, fear of missing out, and buying the stock right at the high of the day when it's completely extended. Professionals just don't do that. They patiently wait for the price to pull back into this supportive pocket, the bone zone, before making their move.
So here is your clinical, actionable entry checklist. Step 1. Confirm your stack. Make sure that 9 EMA, 20 EMA, and VWAP are perfectly aligned. Step 2. Wait for that price pullback right into the 9 EMA or the bone zone. Step 3, and listen, this is the real secret edge here. Wait for a strong candle to actually close. Never anticipate the close. Waiting for confirmation is what prevents you from trying to catch a falling knife. Step 4. Execute the trade.
And this brilliantly illustrates why we need Section 5, strict risk management.
Because honestly, you could follow all those entry rules flawlessly, but one critical management mistake, that can erase an entire month of hard work. Take a look at this number, 1 to 5.7. This actually comes from a recent viral case study over on Reddit. A trader was boasting about making 10 grand in just 11 days using the 9 and 20 EMA cross. Sounds amazing, doesn't it? But looking under the hood, this trader was risking roughly $700 in drawdowns just to make $122 per trade. That is a risk-to-reward ratio of 1 to 5.7. It literally means one full loss wipes out nearly 6 winning trades. Mathematically, it's just a ticking time bomb.
Now, contrast that amateur time bomb with these strict professional risk rules. You should only be risking 1 to 2% of your total capital per trade, period. Your stop loss should be placed logically, right just beyond the 90 EMA or the VWAP structure, and your minimum reward ratio should be 1 to 1.5. And the good news? In today's markets, you can use automated tools like Tradeovate's ATM brackets or platforms like PickMyTrade to automatically enforce these exit parameters the second you enter a trade. It removes that human emotion entirely, which is a total game changer.
But we also have to talk about failure, specifically the failed reclaim. Imagine a stock dips below VWAP. It rips back up above it, and it triggers a long entry. But right above it sits the 20 EMA, which is acting as heavy resistance. The price smashes into it and immediately fails. A great example from our sources was a trade on Robinhood, ticker symbol HOOD. The trader took the VWAP reclaim, but they recognized that overhead resistance, and when it failed, they took a really disciplined 25-cent loss. Getting out quickly for a paper-cut loss when the evidence shifts? That is a badge of honor for sure, not a failure.
Ultimately, the success of this strategy really comes down to the environment. Look at this win rate reality, which is derived directly from institutional tracking. When you trade the exact same 9 EMA and VWAP setup in a perfectly aligned, trending market, you're seeing win rates around 64%. But if you trade that exact same setup when the slope of the VWAP is flat and the market is just completely choppy, that win rate plummets to 36%. The indicator itself doesn't create the edge. The case you build around the overall market structure creates the edge.
So let's pull all of this together and lock in our key takeaways. First, build your case. Remember the lawyer framework. Your indicators are just your evidence. Second, never chase the highs. You have to wait patiently for the price to pull back into the EMAs right into that bone zone. Third, protect your capital by sticking to a strict 1% to 2% risk profile. And lastly, read the slope. Avoid flat, choppy VWAP zones entirely. Consistency is built trade after trade through execution, not perfection.
We've laid out the whole shebang today. You now have a high-probability strategy, from the entry rules right down to the strict risk management. But I'll leave you with this final thought. You have the strategy, but do you actually have the discipline to sit on your hands and wait for all the evidence to align before pulling the trigger? Master your own psychology first, then you can master the chart. Thanks for joining me on this explainer, and I will catch you in the next one.